You're listening to the Financial Source podcast on YouTube.
Hi, everyone, and welcome to the Financial Source podcast.
We are diving into a really volatile session today, one where monetary policy is crossing paths pretty aggressively with geopolitical risk.
And the Japanese yen has just been the clear outperformer. We've had these warnings from the Bank of Japan Governor Ueda.
Right, and that's signaling a serious consideration of a rate hike. December even. It's forcing investors to completely reassess that long-held weakness in the currency.
At the same time, crude oil is firming up sharply. The OPEC Plus decision was one thing, but then you layer on fresh Ukrainian strikes on Russian energy infrastructure.
Yeah, hitting refineries, even the shadow fleet tankers. And we'll also connect these threads to base metals, particularly copper, which just surged to a new all-time high.
All while we're seeing this leadership uncertainty from the Federal Reserve during its blackout period. It's a lot to untangle.
It really is. Here's what you need to know.
So the anchor for all of this, it has to be that incredible turnaround in the Japanese yen, right?
Absolutely. For years, the narrative was just so simple. The Bank of Japan was all in on negative rates, yield curve control. It made the yen the perfect funding currency for the carry trade.
And that trade is now under some intense pressure.
It really is.
Okay, so let's get into the context here. I mean, the dollar has cooled off a bit, sure, but the yen is the real story, the primary driver of this volatility.
Yeah, and Governor Ueda didn't just drop subtle hints this time. This was a serious policy marker. He basically suggested the era of ultra-low rates might be ending much sooner than anyone thought.
But what makes this warning so credible now? We've heard hints before that didn't really land with this kind of impact.
Well, I think it comes down to the timing and the framing of the risk. Ueda made it really clear that delaying rate hikes for too long, say waiting until 2026, risks a much sharper spike in core inflation.
So if they wait, they might be forced into a much more painful adjustment later on.
Exactly. A 50 or even 75 basis point hike all at once, that would completely shock the system.
That reframing, that the cost of waiting is higher than the cost of moving, that's exactly what the market needed to hear.
And he was specific. He signaled the December meeting will include a full-scale discussion on whether to raise rates. It all depends on the updated data they get.
So even if the market is only pricing in, a 40% chance of a hike in December?
Just the tone alone is enough. It forces a massive unwinding of those speculative short positions.
We're seeing the dollar-yen pair trading near the bottom of its recent range. This feels like more than just a pause in the dollar's dominance.
It's a severe check on the biggest structural trade in global finance. And if you look at the broader dollar index, the DXY, it's also pretty subdued.
Right, and the DXY is subdued because the market's suddenly questioning the direction of the very currency it's measured against. There are two big factors capping the dollar's upside.
The first is the Federal Reserve's blackout period ahead of the next meeting.
So we have no fresh guidance from policymakers, an information vacuum.
Right. And second, and maybe this is more politically charged, is the uncertainty around the future leadership at the Federal Reserve. Former President Trump has flagged that he knows who he wants to pick.
And you have several high-profile advisors signaling they'd be willing to serve.
So that leadership uncertainty, combined with money markets pricing in rate cuts for next year in the United States, is creating some pretty significant headwinds for the dollar.
So, bottom line for currencies. Global dollar dominance is facing stress from both inside and outside the U.S. at the same time.
And that's giving currencies like the yen the breathing room they need to stage this kind of dramatic reversal.
That dollar uncertainty, it allows other currencies some relief. But if we look across the pond, we see some specific political dramas creating divergence in Europe.
Which brings us to sterling.
Yeah, it's interesting. The euro is holding up reasonably well against the softer dollar, but sterling is definitely the underperformer of the pair. And it looks like, once again, domestic UK politics are to blame.
They are. Prime Minister Starmer and Chancellor Reeves are facing accusations that they've deliberately overstated the nation's financial problems.
The black hole in public finances.
Exactly. The idea is they're building political cover for unpopular tax rises before the next budget.
So they're accused of padding the deficit numbers to justify fiscal tightening. Is the volatility in the pound really just driven by this? Or is it masking a deeper structural issue with the UK economy?
I think it's both. The political noise itself is a headwind, It just caps any enthusiasm for sterling, but fundamentally the market is nervous about the UK's growth prospects and debt load.
And this black hole narrative just reinforces that skepticism.
It does. It prevents sterling from really capitalizing on the dollar's weakness, so it just stays subdued.
Meanwhile, the more growth-sensitive currencies like the Aussie and New Zealand dollars, they're pretty flat. The Canadian dollar, too.
And this is where we connect back to Asia. These currencies are tied to global trade, raw materials, and they're being held back by fragile risk sentiment and weaker data out of China.
Right. China's latest Purchasing Managers Index data was quite poor. Manufacturing still stuck in contraction.
And the non-manufacturing index slipped below 50, which was a surprise.
That just reinforces concerns about the strength of China's recovery. And since China drives global commodity demand, that skepticism spills over pretty fast.
Which keeps the market mood cautious. This is definitely not a full risk-on environment, despite the yen's volatility.
And that cautious mood, combined with political instability, that always leads us to hard assets. So let's shift to commodities.
This is where the geopolitical risk premium is maybe most obvious, starting with crude oil, which is firmer today, up around 2%.
This move feels like a textbook bullish confluence. You've got supply management meeting immediate geopolitical risk.
On the supply side, OPEC Plus maintained their agreement to keep output unchanged through the first quarter of 2026.
So they signal they're in no rush to unwind that supply discipline, which puts a high supportive floor under prices.
But that bullish impulse was immediately amplified by what's happening in Eastern Europe.
Fresh Ukrainian strikes.
Precisely. They targeted Russian energy infrastructure, hitting the Ifipsky refinery and also tankers from Russia's shadow fleet.
The ones used to bypass Western sanctions. Targeting the export mechanism itself, that's a huge escalation.
It is. Russia's foreign ministry condemned the attacks, including the ones targeting the Caspian Pipeline Consortium's Black Sea terminal.
It just highlights the severe risk that energy infrastructure is becoming a much more frequent and deliberate target in this conflict.
Which significantly raises the supply disruption risk. It maintains a healthy premium in crude prices. Even if minor issues get resolved, the overall balance of risks for oil is skewed higher.
Now let's pivot to industrial metals, because that's where we find the most counterintuitive story.
Yeah.
Copper.
It briefly surged above $11,200 a metric ton, a fresh all-time high.
An all-time high despite that soft Chinese manufacturing data we just talked about. I mean, the move is just, it's completely counterintuitive.
It is. If China, the world's biggest buyer, is slowing down, what single factor could be dominating the signal so much?
It seems that copper has successfully decoupled from those short-term Chinese growth cycles. It's now being priced as a long-duration asset for the energy transition.
So this rally is being driven by persistent structural supply constraints bumping up against this massive ongoing demand for electrification projects.
The messaging from Cisco Week in Shanghai seems to have reinforced that view, that regardless of near-term cyclical dips in things like construction,
The secular demand for building the green economy is just overriding all of that. Copper is essential for electric vehicles, for transmission lines, for charging infrastructure.
and the supply simply cannot keep up with the forecast growth rate.
That is such a critical distinction. It means investors are looking years ahead at the required inventory buildup for a massive global infrastructure overhaul.
It's a powerful long-term signal.
Absolutely. So across industrial metals, you're seeing a signal of persistent structural tightness. It's a real contrast to the cautious mood we're seeing elsewhere.
And where there's caution and geopolitical risk, we naturally look to gold. It's trading toward the top of its recent range.
Gold is benefiting from that softer dollar, but critically, it's also getting a boost from lower real yield expectations.
That's the nominal bond yield minus inflation expectation.
Right. So if inflation is sticky and nominal yields ease, which they would if the Federal Reserve cuts rates next year, real yields fall, that makes non-yielding gold a much more attractive asset.
Then you just layer the generalized geopolitical risk on top of that, and gold functions as the ultimate hedge.
And this isn't about just one hotspot. It's Eastern Europe, the Middle East, tensions in the South China Sea.
With safe haven demand, steady and broader risk assets feeling softer, U.S. equity futures are pointing lower both. Gold has plenty of room to stay supported.
It's the ultimate insurance policy for traders who are navigating all this central bank uncertainty and multiple regional flashpoints at once.
That wraps up a critical look at the cross-currents driving currencies and commodities, from the Bank of Japan's pivot to the ongoing geopolitical risks in Eastern Europe and the Middle East.
Appreciate you tuning in to the Financial Source podcast. Join us again next time for more in-depth market analysis.